Hey guys, welcome back to the channel. My name's Max. I have a good one planned for you today. I'm going to be talking about the new Rex Fund of Funds. Ticker is GIF, and it is coming out tomorrow. Now remember, what you hear here is not financial advice. Consult a licensed professional financial planner. Okay, well, like I said, this new fund is going to be called GIF, as in GIF. Now, this is part of their growth and income focused ETFs. Rex has some a line of ETFs that are called their growth and income line. You could usually tell by the ticker those ETFs because they usually end in two I's, like COII or MSII. We're going to look at some of those. All right, now these funds are going to be weekly payers, and of course that's going to be the primary goal is consistent cash flow. Now this as a fund of funds, they aren't going to really choose stocks. They're just putting stocks in from stocks that are already in the Rex growth and income universe. Now that universe right now, we're going to look at the funds that are in it, but primarily it is a lot of AI exposure, some crypto and DeFi exposure, but they also have some two kind of older economy stocks in there that might make it interesting that some of their competitors don't have exposure to in the fund of funds. We're going to compare it to one of their competitors also, so stick around. Okay, now the strategy on this is they're going to equal weight the funds that are from the Rex line. And I believe, and it said in the prospectus, at the end of the month, they're going to rebalance. But then if there's any new funds that Rex has introduced as part of the growth and income line, those, as long as they paid one dividend, those will fall into the fund. Okay, so you guys kind of get the idea. We've been at this for a while. You know, you can buy a growth stock that doesn't sell, or a growth ETF that doesn't sell any premium, something like a triple Q, or maybe even a leveraged triple Qs, or whatever, but they don't sell premium. They're going to be up big when the market's up, down big when the market's down. Now, these funds that sell premium have a little bit of a different element to them. They can still go up with the market, but they generally do it in a smoother way. And generally, these types of funds go down in a little bit smoother way than the overall market. And of course, the reason for that is the option premium that you're generating. It builds a buffer for you, especially on the way down. It can be helpful. All right, so here's the funds they have in their universe. And ignore where it says Lamb down here. Claude hallucinated that, and I didn't have time to fix it. That one is not in there. Maybe they're coming out with it. Maybe Claude's smarter than I thought, or something, and he's anticipating it. We'll see if Claude's right. But as of right now, this is their underlying funds. They're based on NVIDIA, Tesla, Coinbase, Strategy, Palantir, Lilly, Walmart, Robinhood, and CoreWeave. Okay, like I said, they're equal weighted, and they will add dynamically as they introduce new funds. Let's say they do come out with a fund in Lamb Research. The ticker will probably be maybe LRII or something if that's available. Well, but anyway, if they do come out with that fund and it's paid a payment at the end of the month during the rebalance period, that will go into the fund. Now, by the same token, if for some reason they close the fund down, obviously that will come out of it. Now, the advisor does retain the right to use discretion and sometimes to reweight or to rebalance. In other words, take stocks in and out between balance dates if they have a risk situation they want to manage. All right, so this is kind of a dual engine strategy, and this is the part that's unique about it, and especially compared to their competitors. Their competitors have a single engine strategy, but we're going to look at that. So the first component of their strategy is the growth engine. So what they do, how they're getting a little bit of growth, is they are using leverage. And now they're actually using daily leverage, but between 105 and 150%. And they get long exposure with options and swaps, and that will magnify daily movements. But now they have the income component. So what they do with half of their portfolio is they write options, but only on half. So they have half the portfolio levered between 5 and 50% and unencumbered by options. So that can make a pretty good situation in a bull market. But by the same token, selling premium on half the portfolio, that half the portfolio is going to be capped, but you're getting premium. So that can also help. All right. And we kind of know this by now, but covered calls, there's features and a benefit. And one of the features is you get premium income that's generated. But one of the drawbacks of that feature is you have capped upside. A benefit of that feature is the premium income a covered call strategy generates, not just on this fund, on any fund, is a buffer on the way down. It makes a company that's selling, or a fund that's selling covered calls, go down slower than just the underlying of that fund in most cases, in about 90% of cases. Okay, so like I say, we have between 105 and 150, and that's it's daily leverage, not weekly. One of their competitors does weekly leverage, but they do the weekly leverage on the entire portfolio, and without selling any option premium. So it's a little bit of a different deal. These guys also leverage their entire portfolio, but they lever it daily. So advisor uses real-time risk sentiment and technical analysis, chart patterns, trend monitoring to determine the leverage daily. So it's not a set number, it's dynamic. And what I would think is, if they for some reason think the market may be going down or there's extra risk in the market, they cut it back to the minimum on leverage, which is 5%. But then if they're anticipating, if we're in a bullish environment and they're doing their job well, and to the extent they're able to predict it, I mean, you can't always predict it, but then I would think they're going to put on the higher amount of leverage to try to take advantage of the bull run. Now, the proof's in the pudding. We're gonna see how they do, in real time watching this. Okay, looks like the fund distributes on Friday. I should know that. I didn't know that, but I'm guessing Claude thinks that's true because it's right there. I'll figure it out and put it in the comments. Sorry about that. And they may not have announced it yet. Now, this is important to know. Of course, these distributions will fluctuate. These aren't guaranteed distributions, and they're based on the ability of the covered calls to make money. And not only that, generally these types of funds, the managers sometimes won't give you all of the distributions. At Yield Max, they usually do. But on some of these other companies, sometimes they might, Curve does this. They might pay you 80% of what the fund was earning through option premium and save a little bit to try to smooth out the amounts. Well, the fact that, but I don't think these are going to be smoothed out. I think this is going to be more like the Yield Max plan. Once again, we'll have to see. All right, now the companies they're betting on, so they have Palantir, COIW, Strategy. Now they have those currently, and those have been around for a while. They have it's PLII, CRII, or CWI. It's CWII, and then MSII. A lot of people just call it MS2 because 2 I's, Roman numeral 2. But then they're represented by semiconductors with NVIDIA. And then they have Coinbase and Robinhood. So that I'm calling that DeFi, and then they have, of course, they have Tesla. And Tesla's not a car company, as everyone knows. It's more of a robotics and AI company anymore. But, I mean, they have cars also. So you get some other elements in there. Then as far as the old world economy, they have Eli Lilly, which is a company, a big pharma company that's been around forever. They've been super hot lately, but they've been hot for years. And then they also have Walmart. And I guess, Walmart gives you exposure to the consumer economy. All right, now the fee on this is 24 basis points, and the fee on the other funds is a point, or 99 bips. So this should be a 1.25, but it said in the prospectus they're waiving. It said they're waiving the extra 0.25% management fee through at least February of next year. So basically, just think of this as I'm thinking of this as a 1 point fee, basically 99 bips We'll just round that up and call it 1 point. All right, remember, understand your risk, know what you own. Of course, with all this crypto exposure, a lot of crypto is based on vibes and momentum and stuff like that, speculation, and that may determine more of kind of what's happening than maybe the underlying fundamentals. So that's awesome whenever people like crypto, but it could, of course, it can hurt you on the way down, and you should know that. And of course, all of these are based on single stocks. So that right there is also a strike, against any high yield ETF based on a single stock. Now, but they're throwing like 8 of them together, and there'll be more coming soon. So together they aren't based on a single stock, but still it's important to know this is, not going to be a super diversified portfolio. Okay, now this is where we're going to start comparing it to some of their competitors. Now they have a competitor out there that's called Roundhill, and they have a series of funds that I call the W series, and those pay weekly, and those use leverage, 20% leverage a week, but they don't even write any option premium. That they use total return swaps, and that can have its own features, benefits, drawbacks, however you want to look at it. And we're going to see here, we'll compare all of the existing W funds to all of the existing REX funds. I think that might be interesting. But basically, this chart over here is showing you what can happen to leverage funds. And we've kind of seen this kind of thing happen recently to WPAY, which is the fund of the Roundhill leveraged line, the W series fund of funds. But then, of course, all of these, or I shouldn't say all these, the ones that do sell option premium, have the limit on participation, the capped upside thing to look at. So the good thing about this fund is it uses some leverage, and it sells some premium, but it's kind of has a foot in both strategies. It's kind of hopeful. I think what they're trying to do is use the strategies together and balance out the bad things about each strategy. All right, the management is Matthew Holcomb, who's the senior trader portfolio manager. Now, he's been on the show a couple of times. He was on the Christmas show. I enjoy talking to him. And then he was on, I believe, back in January. Love to get him on again. And I've never met the other Matthew. I guess he's the lead portfolio manager. All right, so let's get in. Let's look at some other stuff here. I made another thing. So we're going to compare it with the Roundhill. Now, I want to make sure. So Roundhill is a weekly reset, 20% leverage swap with no option writing. Distributions funded through the counterparty agreement tied to the swap. In other words, the counterparty pays them. We'll owe them money and pay Roundhill if the market is up. But if the market's down, the total return is negative, then Roundhill will owe them money. But instead of trading in the market, they just do it through total return swaps. They have the same expense fee, but the big thing about the total return, it's not really the total return swaps, but the big thing about the no selling options part of the Roundhill is these guys have theoretically unlimited exposure to the upside, not to mention, not only that, they also have 20% weekly leverage. So that can be a big deal. Okay. All right. I pulled up a chart here of all the funds where they have underlines in common from both companies. Okay. And I guess could have thrown YieldMax in there too, but we don't want to complicate it. I think it's a fair, YieldMax doesn't use leverage. I think this is a more fair comparison, the REX to Roundhill. Okay, so TS2 versus TSLW over the past 6 months. TS2 from REX is up 25. TSLW from Roundhill is up 23. That's a win for REX. Then we have Palantir. Now we have PLTW from Roundhill, which is down 21%, and PLTI from REX, which is down 28%. So that's 1 point for REX and 1 point for Roundhill. And next we have HOOD. So we have the HOODW from Roundhill only going down 37. And we have the fund from REX, HOII, down 47%. Now it's 2-1 Roundhill. Next, we have Coinbase. So in the Coinbase, we have COIW down 50%. Man, remember, that's total return. That includes the dividends paid over the past 6 months. So the NAV's even worse than that, of course. And we also have CO2 from Rex. That one is down 52%. So that's another win for Roundhill. Then the last one is MS2 and MSTW. Now, MS2 from Rex is down 64%. MSTW is down 70% in the past 6 months. And like I say, remember, both of those numbers include the dividends. So, I mean, my gosh, it's been a rough time for strategy. Hopefully that will end soon and this thing will turn around. We'll see. Now let's look at some other time frames. I mean, it may be a little bit deceiving just to look at 6 months. Let's look at 3 months. All right, in the 3-month time frame, TS2 beat TSLW, PLTI beat PLTW, MS2 beat MSTW, COIW beat HO2, and then CO2 beat HOOW. So Rex did better on that one. Roundhill only got one of those. We can look at 1 month just to see how it's been going lately with the market bouncing back. TS2 still on top of TSLW, even in the 1 month time frame. Then on Palantir, we have PLTI down 17% and PLTW down 25%. Another win for Rex. We have in the Coinbase underlines, we have CO2 down 24%, where COIW from Roundhill's only down 18. So that's a win for Roundhill right there. On strategy over this short amount of time, Rex is doing a little bit better. And on Hood over this, 1 month time frame, man, Hood's down 30 per HO22, HOII is down 30% in 1 month. That's crazy. I mean, it's bouncing too. It was worse than that. In HOOW from Roundhill's down 33%. So Rex wins that one as well. And we can go back further, like year to date. Well, okay, yeah, we haven't looked at year to date yet. Let's just look at year to date. All right, year to date, we have 1 win for Rex. Another 2 wins for Rex. 3 wins for Rex. A loss for Rex. Coinbase lost again. COIW is doing better than CO2 in all the time frames we checked so far. And then another win for Rex. So that was only 1 win for Roundhill in that group. So it's kind of a case-by-case basis. Well, obviously, we're going to have to see how these do. I'm going to keep an eye on them like I always do. These will be added to the daily factor and also will be added to the MaxFactor metric. So we check in on the MaxFactor once a night in the daily factor show, where we'll look at different funds and look at the risk-adjusted reward. So I'll be anxious to see how they do on the MaxFactor. Only problem is to be ranked in the MaxFactor, we need at least 90 days of data. So after 90 days, we'll be able to rank these this fund of funds. So its 2 big competitors are going to be WPAY, which is Roundhill, and YMAX from YieldMax is also changing up YMAX is changing up their prospectus. They've been a little on the disappointing side lately, a lot of people think. So it should be interesting. We'll see if the new build of YMAX can compete with WPAY or can compete with GIF, this fund of funds from Rex. Now, I want to remind everyone, this is not financial advice. Consult a licensed professional planner. And that goes for everything not only stuff you hear on YouTube, but just it's good to have somebody looking over your shoulder when it comes to important decisions like finance. If you'd like to support the station, you can do so at paypal.me/maxconvexity. I always appreciate that. It helps me to keep enthused about making new videos and everything. Well, guys, thank you so much for being here. I appreciate your time, and I will talk to you guys soon.